China's electric vehicle industry has been a focal point of global attention, fueled by massive government investments and ambitious goals for market dominance. However, the landscape today presents a far more intricate picture, with many Chinese EV makers grappling with the specter of bankruptcy. Today, we shall delve into the complexities and challenges facing the Chinese EV industry, exploring the rise and fall of key players, the pressures driving the market, and the implications for both China and the global automotive landscape. In recent years, the Chinese government has poured billions into its electric vehicle industry, aiming to establish dominance in the global automotive market. However, the reality today is far more complex. While some companies have managed to thrive, many Chinese EV makers are now facing bankruptcy at an alarming rate, raising concerns about the future of the industry both in China and worldwide. Initially, the EV scene in China saw a surge in the number of registered startup companies, fueled by government subsidies. At its peak, there were approximately 500 registered EV companies in 2019. However, this unsustainable growth quickly led to a significant decrease, with the number plummeting to around 90 in just a couple of years. Even this reduced number proved to be too large for the market to sustain. In recent months, a wave of bankruptcies has swept through the Chinese EV industry. 4 EV companies, along with hundreds of dealers, have filed for bankruptcy. Among them, notable names like Neutron and Line have shocked the world. Neutron, once promising, made the unprecedented decision to refund all customers and cease operations. Similarly, Line, which had surpassed Tesla in sales numbers during its peak, met a similar fate. Perhaps the most shocking bankruptcy is that of Evergrande New Energy Auto, the EV division of one of the world's largest conglomerates. Despite investing billions over several years, the company faced staggering losses of up to $17 million. Another significant bankruptcy case is that of WM, once considered one of the most promising EV makers in China. Backed by major Chinese companies, WM received substantial funding exceeding $5.3 billion. However, despite this financial backing, the company failed to establish a competitive position in China's cutthroat EV market. The downfall of these Chinese EV makers raises questions about the challenges facing the industry. Despite substantial investments and initial hype, many companies struggle to achieve sustainable growth and profitability. Factors such as intense competition, financial mismanagement, and changing market dynamics have contributed to their demise. As Chinese EV makers grapple with bankruptcy, the future of the industry remains uncertain. While some companies may weather the storm, others may face a harsh reality. The situation underscores the complexities and risks inherent in the EV market, serving as a cautionary tale for aspiring players. The pressure on Chinese EV makers to deliver cutting-edge technology while keeping prices affordable is immense. The COVID-19 pandemic intensified this challenge, triggering a fierce price war in the market. WM, a prominent EV manufacturer, struggled to adapt to this environment and incurred substantial losses, totaling $1.2 billion. Although acquisition plans were announced by companies like Kishan Auto Holdings, WM's recent bankruptcy filing has cast uncertainty over these arrangements. Meanwhile, WM Motor has embarked on a massive restructuring effort to attract new investors and revitalize its operations. Even industry giants like NIO are not immune to the market's challenges. Despite being a leading EV company with over 11,000 employees, NIO faced disappointing sales figures, particularly in the second quarter of last year, selling only 8,000 units. This underscores the capital-intensive nature of the EV market, where even established players require significant investments to sustain their operations. As the struggle continues, it's evident that access to capital remains a critical issue for all players in the Chinese EV industry. Furthermore, efforts to optimize production, sales numbers for NIO remained disappointingly low, As a consequence, the company reported losses of $35,000 per EV sold in that quarter. In response to these challenges, NIO pursued various strategies to shore up its finances. One notable move was securing a capital infusion from Abu Dhabi, which granted them a 7% stake in the company. Additionally, NIO received a substantial financial injection from the local government of Hai. However, amidst these financial maneuvers, the founder and CEO, William Li, faced criticism and backlash from disgruntled fans during a customer gala dinner. This incident underscores the intense pressure and scrutiny faced by industry leaders amid the tumultuous landscape of the Chinese EV market. The competition in the Chinese electric car market is incredibly fierce, making it challenging for companies to turn a profit. Even major players like Li Auto struggle to set competitive prices without losing money on each electric vehicle sold. For instance, a new startup called Edo recently launched the M7 model, offering similar features to Li Auto's S7, but at a significantly lower price. In this highly competitive landscape, where startups are slashing prices to gain market share, every company is facing financial losses. While this may seem like a strategy for success, startups are far from secure in such conditions, except for those that are state-owned. These companies are struggling to maintain sustainable operations as they produce relatively small numbers of vehicles. This indicates that their business plans are not viable in the long term. Already, companies like Evergrande, New Energy Auto, Airways, and Neutron have shuttered their factories. Even state-owned entities like FAW Group filed for bankruptcy last year. In this challenging landscape, only startups backed by major companies have a chance of survival. One such example is Zer, a brand established by a major conglomerate. That startup holds the potential to expand into the international market, which may be its only pathway to survival amidst the domestic price war. It adopts a two-directional strategy, focusing on luxury EVs for Asia and Europe, while also exploring opportunities in the robo-taxi market in North America. Now, turning to Evergrande New Energy Vehicle Group, it's fair to say that this company's fall from grace has been nothing short of spectacular. Once touted as one of Tesla's biggest global rivals and boasting a market value higher than Ford Motor Company, it ended its journey with a sales record of only 1,300 electric vehicles and a staggering loss of nearly $24 billion. This translates to a loss of $17 million on every vehicle sold, ultimately leading to its demise. These are undoubtedly turbulent times for the Chinese automotive industry, with no room for small players to thrive. As we've seen, the landscape of the industry is rapidly changing, with the total number of EV companies dwindling from 500 in 2019 to around 90 today. However, this is just the beginning of the shakeup. Many more EV companies are expected to close their doors due to the pressures stemming from the price war and the constant need for further technological advancement. It's a natural process where big fish consume small fish, and China is currently experiencing this phenomenon, with a few dominant companies holding the majority of the market share. More precisely, around 80% of total EV sales from last year were accounted for by the top 10 EV companies. This trend suggests that these companies will continue to consolidate their market dominance. Leading the pack is BYD, a company whose sales numbers measure in the millions. On the flip side, out of the 90 EV makers currently in the market, at least one-third sell no more than 2,000 EVs annually. Experts predict that at least 20 more companies are on the verge of filing for bankruptcy in the near future. Eventually, most of them will either shut down or be acquired by larger players. Among the companies likely to weather these turbulent times, BYD and Tesla stand out as the only two with the capacity for a long-term price war. Their production costs are low, allowing them to prioritize volume over profitability. Then, there are companies like GIE, which may not boast impressive sales records in China, but have a strong presence in international markets. These companies have the capacity to weather the storm in the domestic market. Despite China's leadership in EV technology, its domestic market isn't mature enough to support such a large number of companies. Modest consumer spending stifles local companies' growth prospects, leaving even promising ones struggling. Factors like the COVID-19 pandemic, capital market downturns, rising raw material costs, and a shortage of funds have all contributed to a significant transformation in the Chinese EV industry landscape. Overall, we are witnessing a complete transformation in the Chinese EV market landscape, signaling the end of diversity and the rise of dominant players. As the industry consolidates, the number of Chinese EV companies will likely continue to decline until only a few major players remain. Thanks for watching, and see you next time. In conclusion, the Chinese electric vehicle industry has undergone a tumultuous journey, marked by ambitious aspirations and formidable challenges. Despite substantial government investments and initial hype, many Chinese EV makers are now facing bankruptcy, highlighting the harsh realities of market competition and financial constraints. Factors such as intense competition, pricing pressures, and changing market dynamics have contributed to the downfall of numerous companies. As the industry consolidates, dominant players like BYD and Tesla emerge, while smaller players struggle to survive. This transformation underscores the complexities of the EV market and serves as a cautionary tale for aspiring players. Ultimately, China's EV landscape is evolving rapidly, with only a few major players likely to remain. Thank you for joining us on this exploration of the Chinese EV industry, and we'll see you next time.